Today on the Meet Kevin Report, Dan Locke talks ego, Grant Cardone shows us ego, Jeremy from Financial Education talks about the best places to invest in 2019, and Alex Becker continues his tirade, as well as recent insights from other YouTubers. Good day, folks. Welcome to episode 1 of the Meet Kevin Report, where I try to summarize the week's happenings in financial videos on YouTube and bring you a condensed form of some bottom line bits of information along with some commentary and my point of view on finances. I hope you enjoy episode 1 of the Meet Kevin Report. I'm your host, Meet Kevin. First up, Dan Locke tells us there are 13 types of ego, and apparently I was wrong. I thought there was only one type of ego. Truly though, Dan tells us that in order to be rich, we must avoid these 13 types of ego, and goes as far as saying that being rich really has nothing to do with the amount of startup capital we have or the ideas we have. In fact, and as much as this has been echoed before, what Dan Locke is really saying is, well, shocker, mindset is what's keeping you poor. Except rather than solely relying on mindset, Dan gives us the baker's dozen of ego and starts off his list with a homie rhyme, because how else but to teach financial information with simple human pleasantries. The lame blame.
See, lame people blame people.
That is the first and most important ego to remember and not fall victim to using is the finger point method of blaming other people, because after all, when we point one finger at something else to blame it, 3 point back at ourselves, in effect blaming ourselves, and 1 goes to the God almighty Tesla Roadster? I have to agree with Dan Locke, because quite frankly, the happiest clients and the most optimistic clients are usually the ones that, for whatever reason, oddly enough, end up with the best deal and the most smooth transactions. It's the fussy grinders that get angry at every little twist and turn in the natural world of a real estate transaction that end up with the worst transactions, the worst deal, and the worst fortune. So maybe there is something to pointing up to the Tesla gods. Or at least I just want to see the Tesla stock go up, because that would make me happy. And now I'm pointing all my fingers at myself. So maybe there really is something to Dan's ability to relate with us. Or maybe that's just his ability to change his name from Hylock to Dan Locke. Not sure if I'm pronouncing that right, so let's go ahead and refer to the almighty Google Translate on how to pronounce Dan's name in Chinese. And we'll go with the simplified version.
续落，续落。
Not sure why I didn't find that memorable. Guess we'll never know. Now, Dan also hits it home when he talks about the justification ego. That is, I'm too old, I'm too young, I'm too whatever as to why I can't accomplish a certain task. While I typically agree with Dan because it's difficult to disagree with lots of Locke's lists, it's difficult to disagree with lots of Locke's lists, I actually ended up utilizing the justification ego to justify why I was going to college. In fact, quick story, while I started going to college, I thought, you know what? As I get my real estate license, I should start a business in real estate as I leave high school and transition into college, which is kind of when I started doing real estate, my last bit in high school, and thought, well, golly, even if the business fails, I could still get so far ahead, at least in business experience, get that under my belt, because what else are most people doing in college? Not running a business. So I figured, why not create a business that revolves itself around the individual, the agent, building a personal brand, and hey, may as well give it a shot. And that business, Meet Kevin, ended up paying for my way through college. Now, I'm going to use the same justification ego to explain how Lori Loughlin, or Becky from Full House or Fuller House if you prefer that, helped get me into UCLA. Did you know that I was a pro football player? Yep, a lot of you didn't. You could ask Danny Duncan, and he'll show you some footage of me catching and throwing footballs. So I was able to graduate without debt. So thanks, Dan, for the justification ego. Or is that the reverse justification ego for going to college and not spending $2,500 on a high-ticket closing course? Although, not saying that there's anything potentially wrong with Dan's $2,500 high-ticket closing course. In fact, you should go check it out and let me know what you think about it. But I, for one, am just maybe slightly bitter because I sell a real estate course that I think probably has 10 times the information at 1/10 of the cost. This is starting to make me think that I'm making a mistake selling the course as cheaply as I am selling it. Maybe I need to raise the price. Or maybe this is a nature of passion. Although Kevin David tells us that we need to be financially set and financially free before we start focusing on our passions. And golly, what would that look like? There we go. Yep, just check that off the list. Guess I'm on to passion projects. Regarding the rest of Dan's egos, let me read the favorite ego that I extracted from Dan's videos. The comfort zone, know-it-all, do-it-yourself, excuse, fake, jealous ego. Yes, I just collapsed 6 of Dan Locke's other 13 egos into one massive cluster of an ego. In other words, someone who refuses to learn is a fake guru / rented Lambo douche, will never challenge their opinion, does everything themselves because no one could possibly do anything better than them, and no one else could be trusted, is a jealous asshole that sits on their couch complaining about all of us trying to make a buck and is, well, overall just bitter. Oh wait, those are just the trolls commenting on YouTube. Oh, well, at least they're not delivering full-size poinsettia flowers for Christmas. Coincidentally, onto Grant Cardone. We've heard this before, but if we want to be rich, we need to be growing, because if we're not growing, we are dying. This sounds oddly familiar to Grant's live stream last week when he started telling the poor soul window washer who just wanted to grow his window washing business that he should be washing windows for free. Because why not wash windows for free if you're not washing any windows? Because God knows you could be not washing windows and playing RuneScape at home instead.
I would offer free services. Or something that looks almost free, like windows for $1.
I think what Grant means is if you're frustrated with your window washing business, you should go do some stuff for free so you could try to close some actual deals and get more contracts. But alternatively, you could just play RuneScape. This is not a bad idea, but I wish Grant closed it in a more suggestive way. That is to possibly say, hey, why don't you try to offer business owners a 12-month subscription to monthly window washing, get their first window washing in for $1, so that way they can set up the credit card on autopay, cancel anytime, and now all of a sudden you get owners into the routine of always having clean windows. How's that for growing your window washing business? But I think Grant, and I'll have to give him the benefit of the doubt, but I think Grant was a bit distracted with his excitement to dominate the next caller who called in about margin loans, which ended up being a really interesting discussion. Basically, a caller called in and said, super excitedly, if you had $100 million in a stock portfolio, you could take out a $30 million margin loan and go buy $30 million of real estate. And this is where Grant turns around and crushes.
I would never do that, because if those stocks drop to a certain level, they're going to call the real estate.
Now, Grant did pull an expert move and go on to clarify that with $30 million, you could actually control $100 million of real estate and have a $100 million portfolio, whereas with stocks, it would take you $100 million to just control $30 million of real estate. That is the power of real estate finance. Now, let's put this into perspective here. That's like saying if you had $100,000 in a stock account, you might be able to pull out a loan for $30,000 and go buy some real estate. But the flip side is what makes real estate so powerful. Having $30,000 in, say, a checking account and being able to buy a $100,000 house and then have a tenant pay the loan for you. This one, I have to hand Grant the win. Congratulations, Grant. That was a great pummeling. And in case this person isn't dead yet, Grant continues to pummel the person by suggesting that if the market makes up as so much as a fart and drops 30 or 50%, this person's going to lose his ass. And Grant is correct, because margin loans are famous for margin calls. And if you're only half paying attention because you're one of those multitasking noobs, then let me bottom line you right here and listen very closely. If you take out a margin loan and the market has a hiccup, much like Grant Cardone said happened in 2008, rightfully so, guess what happens? Your assets get sold automatically at the bottom, and that is a pretty loser move. Instead, you should move on to Jeremy over at Financial Education, who tells us that buying real estate is his 5th most favorite way to invest in 2019. That is, of course, followed by buying his course and being interested in investing in individual stocks and S&P index funds, which I couldn't agree more with him. I appreciate Jeremy's advice. If you don't yet know his information, go check it out. But if you do follow the advice of buying real estate, make sure to remember Jeremy's point not to buy new construction homes.
You know, new homes, for instance, you're talking about you're paying the most premium versus used homes than we've pretty much ever had in the United States of America.
Instead, watch my new construction homes exposed video, because I sort of echo what Jeremy says, that new construction homes can oftentimes be oddly overpriced. Now, that's not to say there aren't benefits, but you're gonna have to watch the video to verify that. Now, if you'd like some more real estate information, well, now it's time for a commercial break. If you have not yet joined the real estate investing course, understand that you get lifetime access to over 240 lectures on everything there is to know about real estate investing, from wholesaling and my perspectives on negotiating good deals, communicating with contractors, analyzing deals, how to get wedge deals and great opportunities. And beyond that lifetime access, right now we are doing private live streams twice a week that you could join in. You could join our private Discord servers, ask questions, post your deals, and we'll analyze them together privately as a group, giving you advice to help prevent you from making costly mistakes. Much the same, we have the real estate agent course, where you could join if you're a real estate agent or anybody trying to grow their business in sales and learn how to sell better and close deals better. Make sure to use coupon code St. Kevin for 17% off now as an extended sale, because I was sick last week and couldn't answer all of your DMs on Instagram with questions about the program. Now for a real commercial break. Welcome back. If real estate is not your thing, remember that Jeremy recommends investing in stocks. But if you're a good old value investor, like what Warren Buffett has always been, well, you've pretty much been losing to the FANG stocks. Just like the Wall Street Journal has pointed out, value stocks and pretty much every stock, with the exception of the most expensive growth stocks, have fallen behind pretty much everything. The massive tech companies of Amazon, Google, aka Alphabet, Facebook, and Apple are absolutely dominating the stock market with returns, and maybe their pricey valuations are justifying themselves because they continue to perform. Maybe this means it's time, much like Heinz ketchup, for Warren Buffett to realize there is a shelf life to investing strategies, and maybe the time for Heinz and Buffett's value investing strategy is over. Now, as much as this stock advice and real estate advice can be practical, let's move on over to Gary Vee's video this week, where, oh my gosh, he talks a lot. Here we go. Gary talks about surrounding yourself with less pessimistic people. That is, if you love your mom and love hanging around your mom, but you spend 7 hours with her and she's really pessimistic, maybe you want to take a couple of those hours and give a couple of those hours to that smiling coworker in your office whom you've never gone out with before.
Cutting down their time from 7 hours a week of engagement with their mother to 2, and adding, like, going out of their way to seeing the person that's always smiling in the office.
And maybe, just maybe, your optimistic levels of productivity will increase. But Gary does go on to caution that you want people around you that are practically optimistic.
Start leaning into a little bit more of optimism and positivity. I think where it overcorrects is when it goes into delusion.
Not sort of blindly optimistic. That is to say, maybe somebody could pat you on the back and go, Kevin, you know what? Delivering flowers as an olive branch, great idea and spirit, but don't do it. But why would I sound bitter? Maybe I'm just bitter because now I have to take this stack of blank papers and shove them back into the printer, and eventually, in some point in the future, I'm gonna have kinky, crinkled up paper come out for my real estate presentations, and I'll be kicking the back of this desk in frustration. But it's okay, you won't know about it because the camera will be off. Moving on, which if you can't stand to move on because you want to go watch kitties play on the internet, then you can follow Alex Becker's advice.
And if you can't focus for 5 minutes, you can go back and watch a cat video.
Gosh, that was bitter. Okay, maybe what I really mean is Alex Becker is continuing his relative attack on Gary Vee and Tony Robbins and an overall assault on entrepreneurship by saying that, hey, you know what, Lambos and all this glory and all this entrepreneurship stuff is a bunch of BS, and it's not really what makes you happy. The glitz and glam of looking like a CEO and living the CEO life is not what is an entrepreneur. Instead, it's much more than that. But let's get to what Alex Becker concludes it as, which took me a while to get to because I had a hard time getting and wrapping my head around the planetarium music. Basically, happiness doesn't come from looking or living the life of an entrepreneur or CEO. It's actually building a tower.
So this is a tower.
All right, a little differently, Alex Becker can basically be boiled down into suggesting that you should follow the American. That is, we, the people, deserve the right to be able to pursue happiness. And that pursuit of happiness is actually a perfect bottom line for Alex's video, where we recognize that, what Alex wants us to do is understand that the happiest CEOs and the happiest entrepreneurs who live the longest and healthiest lives are the ones who are always on a mission, on a goal of producing something, and it's actually the journey of doing and making that makes us happy, not the crossing the finish line where we get paid. The money is not what makes us happy. In fact, happiness is a very low threshold to be crossed if you only measure it in dollars. It's about $70,000 a year, according to the Wall Street Journal. And this does sound oddly familiar to what Aristotle advocated in the form of eudaimonia, but let's just roll with what Alex is saying. Then my boy Patrick Bet-David comes out to agree with Dan Locke and suggests that you need to trust people that you surround yourself with. And the biggest nugget out of all of this to grow in life and business is that if you are an entrepreneur, you should be spending 90% of your time on the most profitable 10% of your business. Because most of us, unfortunately, spend 10% of our time doing 10 different things, and we have very, very slow growth. And well, if that is not a good enough nugget for you, maybe you should go to the Vault conference, where entry-level tickets are $699. I would love to go, but I just spent $699 on one phone call with my attorney, and I think after they watch this video, they'll probably get just as pissed as they were on that phone call. Well then, I guess we could end it with Bigger Pockets and their advice of what to do in a recession, or how to prepare for that recession and the crash. And oddly enough, the person in the podcast suggested that you should A, open a home equity line of credit, and B, pay off debt, because that is exactly what he did 6 months ago, which oddly enough 6 months ago is exactly what I said you should do to prepare for the crash. What is the number one thing you should really be doing right now? You should be establishing lines of credit on everything immediately. Today.
Yeah, the next best thing to cash is a credit line. So I went out, I own my house outright. I've never had a mortgage on my house, but I went out about 6 months ago and I got as big a credit line against my house as I possibly could.
Now, if you've enjoyed this, make sure to download it before it gets deleted. I don't have the best track record of talking about different creators and then leaving videos up. Now, if you want the latest and greatest of updates related to any kind of information, or you have a tip for me, make sure to follow me on Instagram. I would love your insights. Send me a DM, tag me in a post, hit me up and follow me, and make sure to subscribe to here as well and be a part of the pre-100K crowd. Pre-100K crowd. Thanks for watching. It's a hard game to play.